Imagine you have 4 credit cards with $20,000 of total credit. Only $500 is reporting, so your overall utilization is just 2.5%. That sounds excellent. But $450 of those dollars sits on a card with a $500 limit. That one card is at 90%. So which number does a credit score see? The reassuring 2.5% or the alarming 90%? The answer is both. And that is why watching only your overall utilization can leave you completely unaware of the card doing the most damage. Credit utilization is calculated 2 ways. Per card utilization is one reported balance divided by that card's limit. Overall utilization adds every reported revolving balance, then divides that total by all of your revolving limits. In our example, card A reports $450 on a $500 limit, 90%. Card B reports $50 on a $3,500 limit, about 1.4%. Card C and D report 0. Together, the balances total $500 and the limits total $20,000. That produces the 2.5% overall figure. Overall utilization is a weighted average. Large limit cards can make the total look calm, while a small limit card is nearly maxed out. FICO's consumer guidance says lower utilization on individual cards and across multiple cards is generally better. Experian, likewise, notes that scoring models may consider the highest utilization on a revolving account in addition to the overall ratio. That does not mean one 90% card causes a fixed score loss. No honest person can promise an exact number of points, because the effect depends on the scoring model and the rest of your credit file. But the signal is straightforward. Using almost all of one available credit line can look risky, even when plenty of unused credit exists somewhere else. This is also where the famous 30% rule causes confusion. 30% is not a magic cliff, and it is definitely not a target. FICO has said there is nothing uniquely optimal about 30%. Lower utilization can receive a more favorable risk assessment than 30%, while higher utilization can be less favorable. Think of 30% as a loose warning line people use because it is easy to remember. Not a promise that 29% is perfect or 31% is disastrous. And remember, if every individual card is low, your overall weighted average must also be low. But a low overall average does not prove that every card is low. So if you have extra money to reduce balances, which card should receive it first? First, make at least the required payment on every account. A utilization strategy is never worth a late payment. After that, if score optimization is the immediate goal, attack the card with the highest individual utilization. Every dollar you pay lowers your total balance, so overall utilization improves regardless. But paying the most utilized card also removes the extreme per card signal. In our example, a $400 payment to card A drops it from 90% to 10%. Overall utilization falls from 2.5% to 0.5%. There is one important distinction. The best order for short-term score optimization is not automatically the best order for getting out of debt. If another card charges a much higher interest rate, paying that expensive balance first can save more money, even if its utilization is lower. Wealth comes before score theater. Use the highest utilization first approach when you are preparing for a credit application or removing a nearly maxed out signal. Use the highest interest first approach when your main problem is costly debt. Sometimes the same card wins both tests. When it does not, choose based on the goal that matters now. If normal monthly spending keeps pushing one small limit card high, you have 3 practical options. Make an extra payment before that issuer reports the balance, spread planned spending across cards instead of crowding one limit, or request a credit limit increase after checking whether the issuer uses a hard inquiry. A higher limit can reduce the ratio, but it is not permission to spend more. Also be careful with balance transfers. Moving debt can leave overall utilization almost unchanged, while pushing the receiving card close to its limit. Always calculate both ratios before the transfer. And do not carry interest just to show activity. A reported statement balance and an interest-bearing balance are not the same thing. You can allow a small balance to appear on a statement, then pay that statement in full by the due date. Very low reported utilization may score better than every revolving account reporting 0 in some FICO situations, but the exact result varies by model and profile. The universal rule is simpler. Never pay interest merely to chase a few possible score points. Here is the rule to remember. Check utilization twice, card by card, then overall. If one card is the outlier, reduce that ratio first when score optimization is the goal. Once no single card is flashing red, keep lowering the total as your budget allows. Low per-card utilization pulls the overall number down automatically. A low overall number can still hide one stressed card. In the next lesson, we will compare reporting one small balance with reporting small balances on every card. Subscribe to Credit and Wealth Academy and comment with the highest per-card utilization you found after checking your own accounts.